better the fund returns are. And if you clearly see here, these two funds, right, 8.31 and 9.31 have not given that much return as compared to the remaining ones. In this video, I'm going to walk you through 8 important factors that we need to consider before selecting any mutual fund. For the example purpose, I'm going to pick up 70 small cap mutual funds, and we are going to apply those 8 factors in a linear way and get to a final position of selecting the mutual fund that we should invest in. Please do not skip this video because we are going to go in a sequence and apply those 8 parameters to filter out funds, okay? Let's go. The very first thing we need to do is go to moneycontrol.com and from there download the mutual fund data, okay? Let me quickly show you. So you go here, click on mutual funds, click on performance tracker, filter it by the small cap fund because we are going to analyze all the small cap fund in this video. And moneycontrol.com will give you a list of all the small cap mutual funds with their respective returns. Simply go ahead and just download this data. I've already downloaded this data and I've already put it into a Google spreadsheet. So you can see I've already got this data, right? Now the first thing we will do is look at the returns, analyze the returns and filter out those mutual funds that have not given good returns. What do I mean by good or bad returns, right? We have to have a benchmark to compare it against, right? So every mutual fund follows a particular index. So some of these funds might be following Nifty small cap 250 index, for example. Some of these mutual funds might be following BSE 250 index, right? I've created a separate video on what an index fund is or what an index is. Please go ahead and watch that video. But for beginners, just understand that we have to go and select one particular index against which we are going to compare these returns, okay? So in this example, what I've done is I have selected S&P BSE 250 small cap index as an example, as a benchmark that I'm going to check the returns against. Second thing we need for us to be able to do justice with the returns is we need to look at the returns of this entire small cap category and see what is that entire small cap category has given returns, okay? So very simply, if you look at the BSE here, BSE 250 small cap, 1 year return is 4.72% because the market has been really down. 3-year return is 15.86, 5-year 6.48. Likewise, for the equity, the small cap one, we have got 2.07, 23%, 11.85%. So basically, overall, the small cap companies have given better returns versus the top 250 small cap companies, right? So therefore, any mutual fund that has given us better return than the equity small cap category, we are going to take them ahead into the race. Any mutual fund that has not given us better returns than this, we are going to discard them, right? Let me show it to you how to do it. So remember, for the 1 year return, we are going for any mutual fund more than 2%. For 3 year, we are going for 23%, right? So let us go back to our sheet here. We are not really bothered about these returns here. So 1 week, 1 month, 3 months, 6 month, YTD, because less than 1 year return, I generally would not consider because that is not a long enough period to be able to consider. So what I'm going to do is simply go ahead and delete all these columns from here. Only keep 1 year, 2 year, 3 year, 5 year, 10 year. Okay. First filter we are going to do is simply go ahead and create a filter here. So we are going to go ahead and create a filter here, and we are going to filter all those mutual funds which are greater than 2%. Okay. Simply go ahead and put it 2%. So we got only now 60 mutual funds, right? Likewise, 2 years we are not really considering, we are considering 3 years. So go ahead and put another filter here. Greater than, we said 23%, right? So now we have these funds here, which is roughly 18 funds, okay? Now these 18 funds have given us better returns or equal returns than the overall small cap category, right? Now, how do we filter it out further? So we are going to look at the second parameter now, which is direct versus regular. Good thing about this data is it already gives us this, right? Direct plan and regular, very quickly for beginners, the difference is direct one is the plan that you are buying directly from the mutual fund house. In the regular plan, you are buying it through a broker, right? So when you're buying it through a broker, what is happening is you are paying more money, more commission is going into their pocket. Therefore, it is going to be costly. I do not recommend to go ahead with regular ones. Just filter out the regular ones. We are only interested in the direct plan. Okay. So with that, let us just filter it out by direct plan. So just direct plan. That gives us now 11 funds. That is our parameter number 2. Now, how do we further narrow down and just understand which is a better fund. So the third criteria we are going to use is the asset under management. What you will see here is that some of these funds are really small. So first, for example, Bank of India is only 290 crores, right? While Nippon is 18,000 crore worth, right? So the concept here is higher the asset under management is, better the mutual fund is. That is, if you look at only through AUM. Okay. Now what we are going to do is, if I look at and analyze this data here, what it tells me is I am going to go ahead with all those funds which have got AUM more than 2,000 crore rupees. Okay. Anything which is less than 2,000 crore is too small for me to consider, because they are not going to give me economy of scale. There is not enough liquidity in that fund, and that fund has not yet grown to a level where I am ready to put my money into risk, right? Because remember, small cap is a very, very risky segment, and we just need to be very, very careful with that. Okay. So what we are going to do is, again, going to filter it out by the third parameter. So filter by condition, go there and say greater than, and just put 2000 there. Okay. So with that, now we get 6 funds that has given us better returns than the small cap category itself. They are direct plan, parameter number 2, and parameter number 3 is their AUM, asset under management, is higher than 2,000 crore. If you're liking this video so far, please hit the like button. Also, if you want this spreadsheet, please drop your email ID in the comment section, and I'll do my best to email this spreadsheet out to you so that you can have it and you can analyze it yourself, and it will be a great value addition into your investment kit. Okay. Now you might ask me, are we now going to filter by 5-year return? My answer is simple no, because if I see it here, this fund has not been there for 5 years. Likewise, this fund has not been there for 5 years. And I do not want to exclude these 2 funds because we have gone to now 6 funds and we need to analyze, right? So I don't want to exclude them on the basis of 5-year returns, right? Now, the next thing we need to do is find some other criteria to analyze these funds, right? What we are going to do is head to the value search online, okay? If you go to value search online, we are going to look at parameter number 4 to 8 now, which are very, very important ones. What I have done is, you will look at the mean, standard deviation. I'm going to explain all of these very simply and in a meaningful way. Okay, so please pay attention now, right? All these data I have taken from value research, and I have now put them in here in the sheet 2 now. Let's now have a look at this. Okay, the first one, parameter number 4. So far we talked about 3. Parameter number 4 is the expense ratio. Now for beginners, let me quickly explain what the expense ratio actually is. Okay, so expense ratio simply is that, let us say if you put 100 rupees in a mutual fund, okay, and if the expense ratio in this example is 0.48%, what it means is 48p of this 100 rupees will be gone towards the managing the fund, the commission of the mutual fund manager and everything. Therefore, higher this ratio is, more money is going into managing the fund. Therefore, it is not good for us. Okay. So therefore, expense ratio, which is lower, is better for a mutual fund, right? So what we are going to do is look at these funds and compare them against this parameter, which is expense ratio. Okay. So let me rub this one out quickly. Okay, so what we see here is that if you look at the expense ratio of Nippon here, it is 1.03 and SBI is 0.76%. So these 2 funds have a really high expense ratio, almost double of the remaining ones. So to me, clearly, I am not very keen on these 2 funds. So I might, remove these. But before I do that, I also want to have a look at the alpha, which is another very, very important factor to consider in mutual funds. Okay, so let me quickly first explain what the ratio actually is. The formula is really complicated. Okay, you are not going to understand it, so I'm going to very simplify it for you. Alpha simply means the excess return a mutual fund has given with respect to their benchmark. Okay, very simply, if we are looking at this index here, BSE 250 small cap, and let us say for 3 year, all these ratios are for 3 year. Okay, so let us say in 3 years, 15% return is what the index has given us. 11% extra return, which is roughly 26%, is what this fund Axis has given, right? That is what I said. It is a complicated formula. It will not tie back exactly, but you get the idea that how much more that particular fund has given over the benchmarked index, right? So higher the alpha is, okay, higher the alpha is, better the fund returns are. And if you clearly see here, these 2 funds, right, 8.31 and 9.31 have not given that much return as compared to the remaining ones, and their expense ratio is also very high. So I am going to remove these two now from this race of the 6 funds. Okay, I hope parameter number 4 and parameter number 5 is very clear to you. Okay, let us now go ahead and remove these funds from our analysis. Let me rub this one out quickly. So let us simply go ahead and delete these two lines from here. Okay, just so that it's very simple. Gone. Okay, the next parameter number 5 we are going to consider is mean return and the standard deviation. Okay, what is it? Very simply, the formula for these two are very complicated. Okay, you can see it on my screen. They are absolutely complicated. We are not going to calculate any of that. This is what the job of mutual fund companies are, that they go ahead and calculate all these parameters, right? They're all out there on the internet. We can go and reuse it. But let us understand how to use them. Okay, that is more important. So for me to first explain to you what the mean return is, let us consider that, let us say this is the time period. Okay, this is 3 years window here. Okay, during this 3 year, what will happen is any mutual fund will give returns like this. Okay, especially the small cap, they will give returns like this, right? Sometimes up, down, or whatever, right? Now, if I were to look at the mean of this return, right, which you can call average. It is not arithmetic average, it is a geometrical average. Again, I'm not going into details of it, how to calculate it, but simply understand at any point in time, if I have to refer and say how much return that fund has given you at any point in time, rather than taking these different numbers at different points, low, high, what I can do is I can arrive at a mean return value, and that is what you see in this column here. Okay, that is what you see in this column here, which is the mean return. Okay, that has been calculated. Higher this return is, better it is for us. Okay, but you see in this example, they are almost the same returns, and this is not going to give us a decision, right? Have a look at the standard deviation. Now for that, I'll have to explain to you what standard deviation actually is, right? So let me rub this part out and explain to you. Okay, so what the standard deviation actually means is, first we have arrived at the mean return, right? So we have got a mean return. So let us say this is the flat line return. If you look at, for example, Axis small cap fund here, their mean return is, let us say, 27.49%. Okay. Now the standard deviation is telling us the volatility of this fund. What it means is simply that, let us say this number is 23.89. It means that this fund can give 23.89% plus or minus than the expected returns, right? So it can give us plus of this or minus of this, right? So plus of this will be roughly 50% return, okay? And this will be almost 0%. So in future, this Axis fund can give us anywhere between 0 to 50% returns, right? Because it is a small cap category, the volatility naturally is very high. So this is an important factor for us to consider here in terms of volatility. So what you see here is that, for example, Axis fund is the lowest volatile, 23.89, but again the difference is not huge. So we cannot really eliminate, we shouldn't be eliminating, because it's a very tight race right now. We shouldn't be eliminating any of these based on the standard deviation. So I've explained to you the parameter number 5, but in principle, in this example, we can't really filter out based on the 5th parameter, but I hope you got the logic of volatility, and lower the volatility is, or lower the standard deviation is, better it is for the mutual funds performance and your future returns, more importantly. Okay. Next parameter number 7, very important. We are going to talk about two important ratios. One is the Sharpe ratio. Second is the Sortino ratio. Okay. The formulas are really complicated. Let's not go there. We are going to understand the meaning of it. So the Sharpe ratio means how much of extra return a fund is giving as compared to if we were to invest the same money into a absolutely risk-free asset class. When I say risk-free asset class, I mean there is absolutely zero risk. So for example, if we were to invest 1 lakh rupees into a bond or into a fixed deposit where the risk is totally zero, versus if we were to invest this 1 lakh rupees into this fund, how much of extra return that fund has given us. Because remember, if we are getting extra returns, we need to make sure the risk is as low as possible, right? That is the meaning of this ratio. Okay, higher this ratio is, better it is. Okay, the difference between Sharpe and Sortino ratio is, the only thing is that Sharpe ratio considers market's movement up and down both, while in case of Sortino ratio, it only considers your risk when the market is going down. So this is a better measure. If you ask me, this is a better measure than the Sharpe ratio. Okay. So now if we look at these funds here with respect to Sharpe ratio and Sortino ratio, what we will find is that they are neck to neck. Literally, there is very little difference. If you look at this, yes, I can see that the last one, Canara one, has done better than the other two, but again, they are very neck to neck. So it is very hard to eliminate basis on Sharpe and Sortino ratio. Let us move to the next one now. If you're liking this video so far, please hit the like button. It will mean a lot to me. Also, if you want this spreadsheet, please drop your email ID in the comment section and I'll be more than happy to send it out to you. Let us now move to our last parameter, which is very important, which is called beta. Okay, so we are going to talk about beta. Let me first explain what this ratio is actually. Okay, so this simply represents sensitivity with respect to the benchmark. Okay, so in this example, we have taken a benchmark of BSE 250 small cap. Let us say that this BSE 250 small cap moves at a point by 100%. It goes up by 100%, right? So this ratio actually means 0.75 here means that the Axis small cap fund here will move by 75%, right? If the benchmark goes down by, let us say 100%, right, it will tank by 75%. So it is a sensitivity with respect to the benchmark, right? So lower this ratio is, less risky it is. Okay, because the benchmark is going down, but it is not going down by that much, right? So therefore, if I look at Axis fund, that is the best fund out of these three, but because I'm a risk averse investor, here there are two types of investor. Okay, if I want to invest in small cap funds, but I want to take absolutely 100% risk, then potentially Canara is a better fund. But if I don't want to take any risk, I want to go as minimum as risk possible, then Axis, because of beta, will win the race, right? What about Kotak here? Why am I not talking about Kotak? It is a very good fund if I can see it here. However, if I compare Kotak and Canara, you can clearly see that Canara wins over Kotak in all the parameters put together, right? So have a look at the beta. Beta is better. The Sortino and Sharpe is better because it is higher than the Kotak one. Look at the standard deviation. It is less than the Kotak one. Also look at the alpha. It is higher than the Kotak one. Look at the expense ratio. It is slightly better than the Kotak one. So overall, Canara wins the race if you are okay to take that extra risk. Although remember, small cap is anyways very, very risky. Okay, so as an investor, if I were to choose, I am going to go ahead with Axis fund here because it is less risky. Its beta is less, right? Let me now show you two bonus tips. Very, very important. Okay, why this ratio is less here? Why? What is causing Axis to be a better fund in terms of risk? Let us go ahead and look at Axis fund. Okay, what you will see here very quickly. So this is Axis. Let me just go back up and show it to you. This is the Axis small cap fund. If I come down here, what you will see is that the asset allocation, if you see for asset, 20%, almost 20% of their assets are going into debt. Remaining 80% is into equity, which again has a mix of large, mid and small cap. They have done a fair bit in the mid, fair bit in the small, right? Because of this debt, the risk in case of Axis is smaller. Have a look at the Canara one here. In the case of Canara one, what you will see, the debt is only 7%. That is where it is more volatile. That is where it is more riskier as compared to Axis, right? So depending on what your risk appetite is, you can go ahead with Axis or Canara, right? The second bonus tip that I want to give you is, irrespective of which one do you choose, right? Let us say you want to go ahead with Axis because you fall into the category of me, which is taking less risk. One thing you must check is go down here and must check the fund manager, okay? The fund manager here has been there with this fund from 2016. Okay, what does it tell me? It tells me that this fund is very stable. From last 6 years, Mr. Anupam Tiwari, I don't even know them, but they have been doing a superb job, right? Because of this, I am very happy that there is no red flag here. If I look at Canara here, let's have a look at Canara one. What's happening in terms of their fund manager? They have got their fund manager changed recently 6 months ago. It is slightly concerning, may not be a big concern again because the fund has been doing really well. But in the last 6 months, they have their fund manager changed. I don't know what the 3-year strategy of Ajay Khandelwal will be versus Shri Dapta Bhandalwar, because actually all our money that we are putting in depend on this person's strategy, because they are going to go and pick specific funds as compared to mid cap or small cap, right? So I hope you saw how I went ahead and started from 70 funds and got to the last 2 funds. And even in that, based on your individual risk appetite, you got to select the fund, not based on what your friend is recommending, what your broker is saying, and what these ratings are saying on the website. I hope you enjoyed this video. If you did, genuinely, please hit the like button. Also drop a comment, and I will see you in my next video. Signing off.